There's only three things. If everybody is here for the same reason, which is to make money, I guess, there's only three things you need to remember. First of all, don't lose any money. Rule number one. Number two, try and make some income if you can, dividends or coupons from bonds. And number three, capital appreciation. And the worst one, of course, is the classic buy and hold. So when I was on the panel earlier on, I was talking about, who's heard the phrase, it's not timing of the market, it's time in the market. You know, that's a myth that's been perpetuated in the city for about 20 years, and it's stuck. It's not true. The problem with panic selling is it's a very easy knee-jerk reaction to do. When you see the market fall, you always see the market do this. You never see the market go up. The reason being is because people don't panic buy. But panic selling is a pretty disastrous. The only time I would sell, the only time I'd do a fire sale is if I was absolutely sure the market was going to crash. And nobody has that information. So it'd be very unlikely for me to ever do that. But if you do nothing, it's the polar opposite. There's something in the middle, which I'm going to show you. If you have a very large position, say GlaxoSmithKline or Centrica, I think someone was asking me earlier what my view was on Centrica. If you know a company's in decline, and Centrica, for example, we short at 160, you have an equity position that you're worried about. You're getting a good dividend, you don't know whether you want to keep it or sell it. What you can do, you can hedge that risk, so you can do a corresponding short at the same time. So what happens is if the market falls, the equity price goes down, but your CFD position goes up. It's a hedge. You're not going to make any money, but you're not going to lose any money. Remember, this is not about making money, right? This is about hedging the position. I said, look, options and CFDs are the two tools which private investors need more than anything else to protect a portfolio, and they're the two things that you're telling me that I can't use. Why? Because they're for sophisticated investors. So the irony is that you don't have access to these products. But I'm going to show you another way around this. But this is something that, again, will help you to protect your portfolio. Has anyone used options before? Has anyone used CFDs before? Did you lose on CFDs? Did you make money or lose money on CFDs? So. Okay, you're two of the lucky ones. Does everyone have insurance on their cars? I hope so. Does everyone have insurance on their homes? Do people have life insurance? So then why wouldn't you insure your stock portfolio? That's insurance. Let me just qualify that so you understand what that means. You don't need to worry about your profits. I'll say that again. You do not need to worry about your profits. Your profitable companies, your good companies, they will take care of themselves. They will take care of themselves. The good company will take care of them. You should focus all of your energy on your losses. If you look at your portfolio tonight and you take out the 25% worst performing stocks, take them off, just delete them from your spreadsheet, see what happens to your performance. The point I'm trying to make is capital preservation is the most important thing. The number one rule of trading is let your profits run and cut your losses short. That's the exact opposite of what most private investors do. They cut their profits early and they let their losses run, hoping for a recovery. Interesting statistic, 25% of all the FTSE 100 companies today pay a yield of more than 6%. First of all, income as a whole is not enough. If you want to be successful in the markets, you need capital appreciation. That alone is barely going to beat inflation. Number two, the big money is on the stocks. We were talking about earlier in the panel, Amazon's gone up 2,000% in 10 years. Now, I don't have it in my portfolio, but I wish I had. But that's where the money is going to be made. And number three, when the market does collapse, and it will, the market will come down. If all you ever do is get income and no appreciation, you will lose money because the market falls. The thing that everyone's making right now, and I do stick out like a sore thumb on this because I'm probably the only person who believes this, is I think the way asset allocation and portfolios are built today is completely wrong. And the reason I say it's wrong is because I've done it a different way for about 11 years and it's worked for my clients. The problem you have at the moment is this. People, your fund managers or your brokers will put 30% into bonds, 20% into equities, 10% preference shares, and they'll have two portfolios, income and growth. Am I right? For most people, is that the case? Even if you build a portfolio yourself, even if you buy a good dividend-paying company, like say, I don't know, whatever it might be, HSBC, how often do you sell a good dividend-paying company? If it pays 6.5%, would you sell that company? If it keeps paying you 6.5%, would you sell it? You wouldn't sell it. Even if the share price goes up, you probably wouldn't sell it, am I right? That's the problem. Here is the eureka moment. I used to work for Deutsche Bank, I used to work for RBS, and I realized this then, and this is what I implemented. That's one of the reasons I set up on my own, because I knew I could make this work. Is there a way that you can combine the two? What if I was to say to you that it was possible that we get that and we get that? Would you agree with me if we were able to do that, if there was a strategy that could do it, and it's so simple, I'm going to show you how it works, that would be pretty powerful. Agree with me on that? Okay, watch this. What I'm about to show you, you will not see anywhere else. We created it, we founded it, we haven't patented it yet. I'm not sure if we can, but this is our stuff, okay? You won't find this anywhere else. And number three, of course, this is a risk disclaimer, it doesn't matter about how well it's traded, you just got to bear in mind, of course, past performance is no guidance for future results. Welcome. Okay, so look, I'm working backwards. Most people, they look at the price, so the dividend yield is the dividend divided by the price, right? Am I right in thinking that? Yeah, okay. What I'm doing, I'm working backwards. So I want to work, so imagine dividend yield equals dividend divided by price. I move the price up here, this is algebra now, move the price up here, and I move the other price down. So the way I work out the price I want to buy the stock is by working out what dividend yield I want for the company. It's going to make sense, don't worry, stay with me on this. The second step is this, when am I going to sell? When the yield goes down to 5%. Think about what I'm saying here. I'm not talking, the reason people aren't making money is because people think, I want to buy a stock at £1.10 and I want to sell it at £1.30. Forget about that. Say to yourselves, I want to buy a company that gives me a dividend yield of 6%, and when it stops paying me 6 and goes down to 4, I'm selling. Work backwards. Now, I know I'm going through this fairly quickly, but once you get it, you will never, it will change the way you invest forever. Trust me, it will. You'll never invest in any other way. So what am I going to do now? 133. Okay, it's not quite 135, 133. I got scared. Okay, it happens. I got scared. 133. Now tell me something. Who said they were happy with 12% a year? Most people. We just made 19% in 2 months. Now I'm not saying it's going to work every single time, but I'm going to show you this happens more often than not. If you can work backwards, you will make money over a period of time. But 19% over 2 months. I can't remember the word Brexit now. This is what you're missing. The fear that people are scared about investing now is being fed into prices. So you need to get outside of your fear. It's called analysis paralysis. Get out of this. If other people are fearful of Brexit, let them be fearful. This is where the money is being made. BT, I'm going to run through a couple of quick examples, then we'll have a quick Q&A. How are we doing for time? 20 past. Oh, okay, I've got to move quick. Lloyds Bank, these are the trades that we were talking about earlier. Lloyds Bank, same thing. Everyone's scared of Lloyds Bank. I love Lloyds Bank. The best bank in the market. But I'm only going to buy it if it gives me more than 6.5% yield. Comes back to the yield again. Think about it. When you buy a bond, when you buy a gilt, when you buy anything, the first thing you say is, you do one thing. You say, what's the risk? How much money am I going to make? It's the same principle. It's exactly the same principle. So now BT, if it's got to hit 50p. If it doesn't hit 50p, I'm not going to buy it. Bingo, 50p. Look at the price. I already know. If if Lloyds says 70p or 80p, I'm not interested. So I might be there for a while. So the way you make this work is you put lots of orders in the market, not one. You put lots of, imagine you want to buy a house for £1 million. You go to your estate agent, you see all the houses for 1.5 million, and you put £1 million off on all of them. You'll get one, right? That's the name of the game. But let me show you a couple that haven't worked, just so you know, just so we can be fair. True positions, limit orders. All these green ones are filled. Limits, 11%, all of them. Bingo, 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 bingo. Look at these. Someone asked about Centrica earlier. Look, Win Centrica, our limit price is 81, current price is 74. That's okay, we're getting paid. We're getting paid 7%, 8%, we'll wait. We'll hold fire. At some point, if they cut their dividend or something goes on, fine, we'll cut the position, we'll take a loss. But look at the profits, 9, 9, 13, 16, just on the ones that have been executed. This is the power of the DIP. These are real trades, 9%. August, that's 1 month, that's 6 weeks. Where can you make 9% in 6 weeks in a regulated FTSE 100 dividend-paying company? You can't do it. You can't do it. The stuff you're being taught by fund managers and all, and I used to be one. I converted. The stuff you're being taught about, put your money into, I won't give names, but the big names. Put money into this fund and we'll give you 8% a year. You're like, oh, great. You can make 8% standing on your head. Yeah, nearly, yeah. Good question, I'm glad you asked that question. The question was, the dividend date might be months away. Remember, you don't care about the dividends. The dividend is your support strategy. So watch, this one, there's no dividend, zero. The dividend is not relevant in terms of you're not buying it for the dividend, you're buying it because it pays the dividend. If it just transpires that you hold the position during that period and it goes past an X dividend date, you just got lucky. But here, there's no dividend, but I still made 9%. Here, there's no dividend, I made 9%. But look at this one. If I get lucky, I'll get paid dividend as well. Bingo. I've got the dividend and I've got the growth. So if it just happens that you hold it for long enough, you're going to collect dividends along the way. That's Lloyds Bank. These are low-risk FTSE 100 companies. Are there risks? Yes, of course there are. The only risk that you have with this strategy is that the dividend gets cut. That's the only risk. But remember, you're taking that risk today anyway. You already have Lloyds Bank. The only difference, that thing that I'm doing different to you, is that when Lloyds Bank goes to a certain level, you're holding and I'm selling. Because you're keeping the 5%, and I know that's going to come back down again. The only time I would hold in a bull market, we're not in a bull market now. We're in a sideways moving market, or we're going to be in a market that's going to collapse. That's the market. The other good news is this is a low risk strategy because it forces you to be in cash sometimes. This is going to appeal to two kinds of people. People who like individual equities, they don't like paying a lot of fees. This is very cost effective. All the stuff I showed you is net of commissions, and who like UK markets. Forget about this nonsense about Brexit. We need to be in the US. Nonsense. Why do we need to be in the US for? You've got currency. I used to be an FX trader for 7 years. What do you want to go to the States for? UK is great. The UK is the best market in the world. You can make more money in the UK than any other market in the world. Don't let anyone tell you to go to Vietnam. You've got no business in Vietnam, except on holiday maybe. You need to realize that the money is here. You can make it work. This is simple stuff. This is the simplest stuff in the world. If you are interested, thank you for attending. If you are interested, I will take questions at the end. I'm probably going to be here for 5 or 10 minutes. We've got the standout stair, London Stone Securities. Thank you very much. Hope you enjoyed it. Don't tell anybody else. That's how to make money.
It was about Brexit. Everybody wants to know about Brexit. What can they do about their portfolios? Feedback was really strong. Hopefully I've allayed some of the fears about what might happen, what might not happen. So we'll see, but I'm quite confident and I'm very glad I turned up.
Well, that was really enjoyable. Actually, it was one of the best events today. I just wish you had more time to go into much more detail. It was really a very rewarding half hour. Most enjoyable. You did well.
I've loved London Stone Securities. Lovely, one of the best stands here. And you've been so friendly, so helpful, looking after me. Very, very intelligent and very helpful and giving good information, good sound information. And this show is one of the best I've ever come to.
Really enjoyed that presentation today. The strategy you told about the dividend income plus, it makes sense because it's combining the dividend as well as the income, the growth, and that was quite interesting. And as a young investor, I think I should be looking more into that.